South African motorists could see themselves buying fuel cheaper soon. This as the government has officially started the process to deregulate the petrol price. Mineral Resources Minister Gwera Mantashe has gazetted his intention to introduce a price cap for 93 octane. This will allow fuel retailers to set their own fuel prices. Currently, the exact petrol price is set by government, and it's against the law to sell petrol at any other price. The minister has, however, not given any details on how the price cap will be calculated and when it will be implemented. The DA had this month presented a bill to deregulate the petrol price in order to lower the price at the pumps by 9 rand a litre. Now, the South African Reserve Bank's Monetary Policy Committee has resolved to raise interest rates by 75 basis points. This has brought the repurchase rate to 5.5% and the prime lending rate, which is what banks charge customers, which has now risen to 9%. But some analysts are warning of more increases to come. For more on this, I'm joined by economic analyst Bongani Mahlangu. A very good evening to you. Thanks for your time. We've just learned that the Energy Department is going to begin the formal process of deregulating the petrol price. What's your reaction to that?
Thanks for the invitation. I'm interested in looking at the terms of reference, because if they're going to deregulate, we must also look at from which aspect of the value chain will they do so. But of keen interest to me is that what we needed as South Africa was buffers with regards to runaway energy prices. And buffers would have mean stocking up excess of oil in order to ensure when times like this, when shocks take place in the economy, we are able to better absorb those shocks. Because currently, we are told that these runaway prices are caused by the Ukraine or Russia-Ukraine war, because they've affected the energy market or the oil market globally. But then what is our exposure to that? Is that what the department, the DMR, is not letting us know? Because as seated here, I don't even know where we get supply. So because we know we are a price taker, we know that we import oil, but where do we actually import it from? Because I'm looking at the fact that you have other BRIC member states, such as your China, that has been stocking up on oil at discounted rates from Russia. You have your India is also a BRIC member state that has also been stocking up from discounted oil from Russia. But you have South Africa that does not actually give detail, or the government does not give detail to from where do we stock up. Because if we were to stock up from the same sources, these two other BRIC member states have been stocking up, we should have been able to absorb these shocks that are currently taking place in that market. But seemingly we are not. So even with this one, I think I have not really read, because I heard about it today as well when I was traveling. But I'm going to look at it, look at the terms of reference, look at where in the value chain do they want to look at, or they're going to look at the entire value chain, because these things are broken up in so many parts. For example, you have your exchange rate, you have your transport costs, moving it from country A to country B, and then from country B, you have to move it from a port to inland or to wherever the refineries are, storages are. You have your marketing costs, you have your fuel pump costs, which are your retail costs, your wholesale costs. So there's so much that goes into the price that we actually see. So we have to know where exactly are they going to pinpoint their exercise.
And what do you imagine to be the ripple effect, especially against the news that we heard yesterday with the prime lending rate, which has now risen to 9%?
So basically, when I read, I think it's seven pages, the speech by the MPC, what I liked is that they did give variables as to what they would have looked at when they made the upward adjustment, so when they implemented the contractionary monetary policy. So interestingly enough, as I said, it's quite interesting, and I like that level of detail, because they did speak about globally what has been happening. So that means they looked at mostly the global shocks, such as they even started with COVID-19 pandemic, the aggravated geopolitical tensions, so that would be Russia, Ukraine, and the sanctions and everything that emanated from that. They look at the persistently high inflation globally, weaker economic growth globally, also the fact that the northern hemisphere is going towards winter now, and we know that the west of Europe, they are reliant on Russian gas supplies, And what would that happen? Because seated where they are seated right now, they're very nervous as to how they are going to absorb the winter if Russia decides to reduce the supply to those countries. We have seen Germany and how they are adjusting their energy policies in order to be able to position themselves accordingly. And then they went on and looked at domestically what has been happening domestically. So domestically, they spoke about normalization. So normalization is basically contractionary or contractionary monetary stance is what they are doing now, trying to reduce the number or the money available in the market, which would have happened because of sustained policy accommodation that would have took place when COVID-19 began. So that is basically when they were increasing liquidity into the market. So they were increasing cash into the market in order for the South African domestic market to be able to maneuver around COVID. They looked at supply shortages. So these supply shortages, some are caused internally on the basis that the cost of production has increased, or some are caused globally because we do import certain things, like from your Ukraine and so forth, so that would have caused issues, slowing economic growth. We know that, yes, we did project some good GDP numbers, I think, in the last quarters, but that was mainly because the global market was opening up. They needed primary inputs in production and, South Africa, mining and so forth. So that did give us good numbers. Even the tax guy collected some significant amount of money. Mm-hmm. But our economy has not been relatively doing well as measured according to the gross capital formation, which is investment into the economy. So we have not been investing anything into the economy. And in fact, gross capital formation has been going down since the height of 2008, relatively going down. So that means there are no major investment in infrastructure in this economy. Machinery breaks, it's not being replaced. When infrastructure reaches its design life, it's not being replaced, and so forth. So, and they also looked at other restrictions that would increase price of goods, services, and commodities. Yeah. And then they had to balance that, and that is what they did with the numbers they gave to us. Mm-hmm. But it will obviously hurt our consumers, more especially when you look at the prime rate, because no one actually gets 9% when it comes to prime. If
you'll allow me to interrupt you there, the South African Reserve Bank Governor Lesetja Kganyago spoke to how this increase is necessary to protect the incomes of South Africans, as he justified why the sudden jump, why the drastic jump.
When it comes to household disposable incomes, they've been under pressure for a while now, even before the riots that took place last year. So as far as that's being said, I don't think there's much protection of household disposable incomes in South Africa, because if you look at it, even before this hike, even before this year, you'd find that about 0.75% or 0.75 cents of every R1 generated by our households went towards servicing debt. And that was before this increase. So now that means then there has been significant erosion of household disposable income for a while now. And this will not really assist. And also, even if you look at, I don't want to get too much because they will always argue that it's ideology and stuff like that. Yeah. But you'll find that the Reserve Bank would always make citation of Section 224, subsection 1 of the Constitution that speaks about their mandate. And then after that, they would go and speak about protect the value of the rand, and so forth and so on. So they hardly ever make any assertions as to protecting households, protecting the working class household in South Africa. But interestingly enough, even your high-end households have been feeling the pinch on the basis that when it comes to credit default, they have been increasing in credit default as well, which is things that we have not been seeing before, but they are happening now. So if such households are defaulting, you can just imagine what happens to the lower income households, your middle income households. And in South Africa, you find that 70% of our households earn about 7,000 rands or less. and then about 8% would then form that so-called middle class. So households have been under strain for a very long time, and a lot of people have been saying that the Reserve Bank must do more to protect them, because as I said, if we were at 0.75% or 0.75 cents of every R1 before this, that means it's most likely to increase the servicing of debt after this. And the default rate is most likely going to also increase significantly. So they must demonstrate what exactly are they doing, and they must give us the numbers to that effect.
Very well. Let's leave it there for now. Thank you for your time.